From Impact Alpha, it's This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. It's Friday, February 21st. I'm Brian Walsh, and this week I'm joined by Impact Alpha editor David Bank. We'll discuss how investors in emerging markets, small businesses, and climate strategies are charging ahead despite the turmoil emanating from Washington. Plus, how lower fee co-investments affect the LP-GP relationship. And finally, how the University of Utah is seeking to become an epicenter for impact investing. That's all coming up on This Week in Impact. Hi, David. How are you doing?
I'm doing great, Brian. How are you?
Doing well, thanks. I understand you were in Salt Lake City this week.
Yeah, it's such a beautiful place. The mountains are so close to the town, and I'll tell you all about it in a little bit.
Sounds good. But first off, we had a series of articles this week on how a wide array of investors, from those investing in emerging markets, small businesses, and climate strategies, are trying to find ways to deploy money despite the upheaval and confusion stemming from the first month of the Trump administration. About that confusion, a case in point, as Amy Cortese reported, the new administration is trying to claw back $20 billion that had already been awarded to establish a green lending network as part of the Inflation Reduction Act passed during the Biden administration. David, where does that effort stand now?
Well, it's kind of hanging in the balance. There, as you say, there's $20 billion that it's sitting in Citibank. The EPA is trying to get it back, but the bank has to, decide how it's going to play, defending its customers, bank accounts. And it's going to be a fascinating, battle over rule of law and banking and banking procedures. The head of the criminal division in Washington, D.C. in the Justice Department resigned late last week, apparently over the demand that she initiate a criminal investigation, which might be required in order to claw back the money.
All right, well, let's shift to small businesses in Africa. Our Lucy Ngigi had a piece this week on how African leadership is stepping up to reshape the continent's small business investing ecosystem. Now, this is in the midst of the Trump administration's abrupt halt to foreign aid. So, David, how has the cutoff of U.S. assistance changed the investing landscape among African investors?
Well, Brian, this was something that was going on, has been going on for a long time. But obviously, as you say, given new urgency as USAID pulls back and other foreign aid pulls back. But the African investment ecosystem has been, becoming more African-led for some time. Lucy was keying off a report from a French investment manager called I&P that mapped out something like 135 small business and VC funds in Africa. And of the small business funds, something like 80% are led by African general partners. The other thing is, of course, that the African LPs or asset owners, in particular pension funds, are starting to become more active in backing these emerging and early stage managers, which had been something of a bottleneck for the big institutional investors. So there's CNPS in Cote d'Ivoire, there's the Kenya Power Pension Fund and Ghana's Mineral Income Investment Funds, and they're all beginning to back early stage funds, led by African fund managers. So the I&P report said it's become an African-led ecosystem.
So shifting from small business ecosystem to development finance, let's talk about a guest post we had this week from the CEO of British International Investment. That's the UK's development finance institution. DFIs historically took a buy to hold approach to investing. They invested their own capital, often alone, and held it for years or even decades. So that kind of practice is really hard to scale, especially if you're reliant on only the balance sheet of the DFI. So how is British International Investment, BII, looking to change how it thinks about its investment approach?
Yeah, this is the new head of BII, Leslie Masdorp, and I think with this post, he's essentially signaling that he's on board and moving forward with, I think, what the agenda of the development finance world has been for the last couple of years. In particular, taking on more risk, injecting concessional capital and guarantees into deals, and bringing in new fund managers and rotating the capital. Another one we like is improving the transparency of the deals data. database of the loans that these development finance institutions make. And they've kept it for decades in something called the GEMS database. And it was essentially secret. Just in the last year, there's been a move to kind of liberate some of that data. And of course, it shows that the risks of small business lending in some of these emerging markets turned out, lo and behold, to be much less than had been kind of popularly conceived. And that, in fact, in the commercial markets, some of these countries and some of these ventures were paying higher interest rates as a result. So as that data becomes more available, people start to see the real risks, and hopefully that brings down the cost of capital a little bit.
Right. So these TFIs, which are supposed to help unlock commercial capital, they can also inadvertently crowd out commercial capital by having better terms.
Yes, exactly. And in fact, that's the point of the piece is to how the DFIs can help crowd in commercial capital. In fact, the BII is launching a contest with Mercer and putting up something like 100 million pounds, which is about $125 million, towards innovative asset management strategies that can bring in particularly pension funds and insurance funds into emerging market climate finance. And so it'll be interesting to see what the asset managers come up with as ways to make this an institutional asset class.
All right, now let's next turn to the optimism conveyed on a recent earnings call from TPG's executive chairman and co-founder Jim Coulter. So David, why did Coulter express confidence in the future of climate and impact investing?
Well, the main reason somebody like that expresses confidence is because they're having great success in their fundraising. The TPG Rise Climate Fund 2 is close to something like $5 billion that it's targeting. The TPG Rise Climate Global South is targeting $2.5 billion. Their first climate infrastructure fund has already gotten something like $2 billion towards a $6 billion target. So he's got his finger in the wind, and if the LPs are putting up money into the TPG funds, it looks like maybe momentum to him. They've also been taking on some deals themselves, and like they did this take private deal for a solar developer called Altus Power, and it was worth something like $2.2 billion. And Coulter said on the call that the headwinds in U.S. policy had depressed the value of Altus as with many other solar and renewable stocks, but that just made it cheaper to take it private, and that was an opportunity for TPG. So that's the way a guy like Jim Coulter thinks. We think it's kind of fascinating because he was not he did not come up in the impact or climate side. He got kind of drafted out of the main part of TPG to run TPG Rise a few years ago, and he's really become a climate champion and as you said, a bullish booster.
Speaking of bullish, you can read all of these stories on impactalpha.com. We'll also have links to them in our show notes. But let's take a quick break, and when we come back, we'll discuss Impact Alpha's new LP/GP newsletter, starting with how co-investments are changing the nature of the relationship between asset allocators and fund managers.
The Impact Alpha Podcast Network is proud to amplify smart conversations by and for impact investing professionals.
Welcome to the Market Makers podcast, where you can listen in as we interview leading asset allocators, investors, founders, policymakers, and more, who are all working together to build an inclusive economy.
Join Troy Duffy and Lenore Champagne Byrne for the Market Makers, part of the Impact Alpha Podcast Network.
David, this week, Impact Alpha officially launched our new LP/GP newsletter. Why is this an interesting beat for us to dig deeper into?
Well, first we should just say, for anybody who doesn't know the lingo, that LPs are limited partners, the folks with the money to invest, the pension funds at the one hand and the family offices and high net worth individuals. And then GPs are general partners, and they're the managers who run the impact funds that we talk about all the time. And they raise money from the LPs, and then they put it to work with entrepreneurs and founders and other kinds of initiatives. So the relationship between LPs and GPs is a fascinating topic. We think of it as like the real business of impact investing. I mean, if you're a impact investor, you're either somebody with the money and looking to put it to work, or you're the fund manager who raises that money and then puts it to work. And so just the way the money flows through the ecosystem, has all kinds of interesting nuances, about who holds the power and who gets paid how much and how does that all work. So for folks who want to know about that part of the business, we're dedicating our our Tuesday brief to this beat. So the Tuesday brief is now the LPGP edition, essentially, of the weekly brief, and we'll have these kind of features and resources and tools all collected on Tuesdays for folks who want to focus on that area.
All right. So in an article for the debut of this new weekly edition, you wrote, from early stage VC through growth stage private equity and across the private credit and infrastructure markets, general partners have had to accommodate themselves to the fact that their deep-pocketed limited partners want to piggyback on their best deals without paying full freight on fees. So, David, how are co-investments by LPs affecting the LP-GP relationship?
Yeah, this is, co-investments are an example of that power dynamic. And essentially, it's a chance for the LP, the pension fund, as it were, to be able to make an investment alongside the manager, which it's also an investor in. So the fund manager goes and finds a good deal and negotiates the terms and comes to an agreement, but then it makes some part of that deal available also to its own LPs. And what that does from the LP's point of view is it lowers their fees because they're not paying the fund manager to manage that money. They're putting it directly into the deal. They don't, generally speaking, have the capacity to source those deals, those direct deals themselves. So they rely on the fund managers to find and structure the deals, but then they put the money in directly, and they don't pay the fees to the fund manager. So you can imagine this is somewhat of a mixed feeling. The fund manager is happy to keep its LPs happy, but why doesn't that money go through them and let them take their fees out of it? So this is the sort of dance the LPs and GPs have been playing around co-investments, which used to be a kind of a minor part or an occasional arrangement. Now it's become essentially central to the whole private equity market. And in some cases, like up to 50% of the allocations and 50% of the assets being raised are actually not going through the fund managers anymore.
Right. And so for large pension funds like CalSTRS or CalPERS, the big pension funds in California, they're saving billions of dollars in fees and carried interest. But one person's cost savings is another person's lost revenue.
Yeah, exactly. CalSTRS put out a report a couple of years ago, and they've kind of been one of the pioneers of this. I think it actually started with the Canadian pension funds, and then the Californians, of course, picked that up. And those are the sort of two of the sometimes leading, lights in pensions, and it spreads to others. But CalSTRS said that it saved $245 million in fees and carried interest in 2022, the latest number we could get from this co-investment strategy. And then CalPERS had an estimate that if they did a $1 billion co-investment, they saved over the life of that investment something like $400 million in management fees and carry. So this is real money, as you say, that's money that's not going to those fund managers, and that boosts returns for the beneficiaries. But as you say, it cuts the fees for those fund managers.
So what's the flip side of this argument? What are the benefits of these co-investments?
Well, the one is, lower fees are a benefit if you're on the LP side, and maybe if you're a retiree and that's your fund. But on the other side, on the fund manager side, they now are kind of accommodating themselves to this and say, look, we can now bring more capital to the deal. Especially in things that are sort of capital intensive, like climate infrastructure. We now got money coming directly from these big pension funds into these deals, and we couldn't have put that kind of money in ourselves. Is what some fund managers argue. The other part of it is that maybe they wouldn't have gotten that money in the first place themselves because there's things like concentration limits, and so the institutional investor can't take too much of a fund, and so therefore it was always going to go somewhere else. It might as well go into the same deal that you negotiated and that you think is a good deal. So it's gone from sort of somewhat of rolled eyes and like something you have to put up with, and now they're trying to make the best of it.
So an image that came to my mind, David, as you were speaking, was this idea of a race car. And instead of thinking of the co-investments as a parachute or a drag on the performance, it could be seen as a turbo boost to help take these investments to the next level.
Or maybe they're carrying it further. Since everybody's got the turbo boost, you better well have a turbo boost of your own.
There you go. All right. Well, you can read David's article on the LPGP relationship on impactalpha.com, and we'll also have a link for you to subscribe to the LPGP newsletter in our show notes. For now, let's take one more quick break, and when we come back, we'll discuss Utah's new effort to be an epicenter for impact investing.
Maybe it's a story in the brief or our monthly Agents of Impact calls, or an exchange in one of our subscribers' Slack channels. Impact Alpha is all things impact. Hi, I am Slayem Abibel, co-founder and Chief Operating Officer of Impact Alpha. For more news and insights about the world of impact investing, join thousands of others finding alpha and impact. Visit impactalpha.com/subscribe to learn more.
David, as we noted at the top, you were in Salt Lake City this week for the launch of a new building at the University of Utah. Tell us about it.
Yeah, I went out there at the invitation of the Sorensen Impact Institute, and we've been partnered up with the Sorensen Group for many years. Folks might know that they're an investor in Impact Alpha, and they've also endowed and set up this new building on the University of Utah campus that's kind of pioneering a new form of impact education. So it's both live and study. And the students, I think something like 800 students live in this building. And then there's offices both for the Sorensen Impact Institute and for something called the Center for Business, Health, and Prosperity. And so I went for the ribbon cutting, and there was literally a ribbon and then two big scissors, and they opened the building up. And it really gave me a view that, how this kind of impact idea has taken root in education, because the president of the university and the dean of the business school were both there, talking about how excited they were and how excited all the students were to sort of be able to immerse themselves in some of these ideas. And I also learned a little bit about the structure of the financing for the building itself, which is something of an impact investment. And folks might think of universities having endowments, and endowments can pay out something like 4% a year. But so instead of just making a donation and creating an endowment that paid out 4%, Jim Sorensen, a noted investor and finance guy, helped structure a deal that pays 8%. And what they did was they put up some philanthropic capital, but they also floated a low interest bond from the state, something under 2.5%, I think, and built the thing. And then the student housing fees that they would pay in any event for their dorm rooms pays back the bond and gives the investors an 8% return, which is all plowed into the operations of the institute and the center and the building there. So both a great facility in and of itself, and also sort of a great model for how you can use finance in creative ways.
So being at the event with all those students, what can you say about the next generation of impact talent?
Well, I think things that people are fired up. All of the impact finance and social entrepreneurship courses are packed apparently at the business school. The business school there is both undergraduate and graduate. The institute, the Sorensen Impact Institute itself, has a number of students, as fellows and interns, and they due diligence deals, and they're looking into nature-based solutions and digging in on impact in public markets. All kinds of projects, and everyone I talked to was super sharp and super committed.
All right. Well, we'll look for more from the Impact and Prosperity Epicenter at the University of Utah in the coming months. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thank you, Brian.
This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next week for more Impact.